Good afternoon. Jason Pries here from Pries Capital Investment Research. This November report was released November 10, 2025. It's built to be advisor-ready so you can reuse the visuals with clients and prospects. Today I'll connect where returns came from, why leadership continues to favor quality growth, and how an easing policy path, mixed macro, and a flatter curve shape our equity, rate, and hedge sleeves into year-end. We'll move from asset class and index performance to equity styles and sectors, then macro, employment, inflation versus the policy rate, housing and mortgages, services momentum, and finish with the curve and bond funds. The objective isn't to read numbers, it's to interpret what they mean for portfolio construction, where to lean in, where to hedge, and what to avoid as we navigate a carry-friendly regime that still punishes weak balance sheets. Use this deck directly with clients. It's designed for clarity and repetition. At the top level, risk assets remain supported as policy shifts toward normalization. Within multi-asset sleeves, equities continue to drive total return while quality duration regains some hedge utility. For allocators, the message is stay invested but be precise. Beta still pays where earnings visibility and balance sheets are strong. Indiscriminate risk still gets penalized. Keep the equity core in high-quality growth, complement with selective cyclicals tied to services strength, and fund that from lower-quality names where multiple expansion outran fundamentals. In diversifiers, keep modest convexity, duration on the belly of the curve and a small precious metal sleeve, so you don't need a crash for hedges to help. The overall tape is constructive breadth, leadership intact, and dispersion that rewards underwriting over momentum. This visual makes a point about scale and concentration. Mega-cap leaders, typified by Nvidia, now rival entire countries by market cap. That scale isn't just spectacle, it tightens the link between single-name fundamentals and index-level outcomes. For portfolio design, concentration is both a strength and a vulnerability. Our response isn't to shun the leaders, it's to own those with durable moats and cash flow visibility while we deliberately broaden into mid-cap compounders and service-oriented cyclicals where revision breadth is improving. With concentration elevated, hedging and position sizing matter more. Trim exuberant multiple expansion, recycle capital into durable growers with catalysts, and keep optionality where exposures are most concentrated. The lesson is to accept concentration as today's reality but manage it with underwriting rigor, not with blanket avoidance. Equity performance continues to be the fulcrum of returns. The section you're about to see combines index tables, style factors, sector scorecards, and single-name dispersion so you can translate market leadership into allocations. Leadership remains growth-centric, participation has broadened, and dispersion is persistent. Ideal conditions for active upgrades. We'll focus on 3 questions. Are we being paid to take risk in the right parts of the market? Where is pricing power intact if growth cools? And which names can self-fund through an easing cycle without the market's kindness? Our stance remains consistent. Quality growth as the carry engine, selective cyclicals where services momentum supports end demand, and disciplined trimming of overextended multiple expansions. On a trailing 12-month basis, all major U.S. indices are positive, with the Nasdaq up roughly 32% on a trailing 12-month in October. All indices were positive again, led by the Nasdaq at plus 4.7%. Reading this correctly matters. First, the market continues to pay a premium for durable growth and balance sheet strength. Second, breadth is good enough that you don't need to chase the far-right tail. Core plus beats all beta. Keep the S&P and Nasdaq core funded. Use weakness to add to compounders with positive estimate revisions and clean free cash flow. And treat EM and small cap adds as paced rotations driven by currency, policy, and refinancing calendars, not by hope. We're not bargaining with gravity. We're underwriting earnings durability in a regime where real rates are drifting lower from restrictive levels. Style remains decisive. Large cap growth surpasses 30% on a trailing 12-month basis, with small cap growth second. October extended the pattern with large cap growth leading again while all styles finished positive. The market still prefers visibility and balance sheet strength in a soft landing, policy easing backdrop. But don't overconcentrate. Blend the leaders with mid-cap compounders and selective cyclicals, and avoid buying value solely on multiple if cash flow durability and pricing power are questionable. In practice, use revision breadth and free cash flow yield as your compass, not just style labels. Sector scorecards are clear. Technology is positive 36% on a trailing 12-month basis, and in October it led again at a plus 6.7%, while materials lagged and healthcare is roughly flat over the year. This reinforces the structural overweight to quality tech and semi-cap equipment, where easing financial conditions meet secular compute demand, paired with select financials where NIM pressure eases and fee income is resilient. Keep healthcare tactical. Policy and pricing clouds can cap multiples even with fine fundamentals. The question for each sleeve: where is pricing power intact if growth downshifts a gear, and which balance sheets can self-fund through 2026 maturities? You will need to allocate accordingly. The winners cluster around semiconductors, software monetization, and select platforms with operating leverage, classic beneficiaries of easing conditions plus secular demand. This is not a green light to chase the top decile. It's a map to where revisions, unit growth, and cash discipline converge. Use it to identify adjacent names with similar economics but less crowded positioning. Trim exuberant moves where thesis drifted. Recycle into durable compounders with credible catalysts. This is alpha via underwriting, not lottery ticket hunting. Laggards skew toward policy-sensitive healthcare, levered consumer, and idiosyncratic execution misses. The lesson is simple: beta doesn't rescue weak fundamentals in this tape. Use this list to fund upgrades, reduce exposure where balance sheet or pricing risks are unresolved, and redeploy into names with cleaner catalysts, better cash conversion, and estimate momentum. You're not buying the market. We're curating businesses that can compound through an easing cycle and defend margins if growth cools. Let's pivot to the engine room with employment, inflation versus the Fed funds rate, housing and mortgages, and services. The goal here isn't to gawk at charts, it's to connect macro to positioning. Into year-end, we're navigating a glide path where inflation moderates, labor cools without cracking, housing stabilizes as mortgage rates step down from peaks, and services hover at expansion. That mix supports keeping quality risk on, adding measured duration, and maintaining convexity in the hedge sleeve. Labor data signals cooling without collapse, exactly the scenario the Fed wants as it normalizes policy. For equities, that supports multiple stability so long as earnings breadth holds. For credit, it's carry-friendly, spreads grind rather than gap, but underwriting still matters. Positioning favors businesses with operating leverage and pricing power. Avoid those that rely on generous markets to roll debt. This is how we keep risk on while respecting the cycle. This overlay is the fulcrum as policy eases and inflation glides lower. Real rate pressure on duration falls and the present value of high-quality cash flows improves. That's why even modest rate declines can lift quality growth and restore duration's hedging role. But we're navigating toward neutral, not stimulus. So we prefer the 3 to 7 year belly for roll down and convexity, and we keep long duration as a tactical hedge, not a core income engine. Equity implication is to own visibility, be ruthless about cash conversion. Housing and mortgages show tentative stabilization as rates step down from peaks. Affordability is still tight, so the winners are issuers and operators with product where demand is resilient. Homes with updates still matter, price points with real buyers, and geographies with job growth. With bond sleeve implication, you must be selective in RESI-linked credit. Prefer quality where cash flows are visible over speculative projects dependent on easy capital. Equity sleeves favor distributors and building product players with balance sheet strength and pricing power. Services sits at the expansion threshold, critical because services is the economy's dominant engine. Expansion supports spreads, earnings breadth, and the Fed's confidence to normalize without panic. You must maintain quality risk, add selective cyclicals tied to services activity, think payments, platforms, and travel adjacent. And stay disciplined on balance sheets with limited pricing power. If services momentum persists, breadth improves. If it dips, your duration hedge and convexity sleeve do their job. Crypto had a difficult October. And why do I even include it here? Because many clients view crypto as either a risk proxy or a diversifier. The signal we take is about liquidity preference and risk appetite, not a reason to abandon core allocations. Keep your core equity and rate sleeves driven by fundamentals. Treat crypto, if held, as a small satellite exposure with explicit risk limits, not as a hedge or a substitute for duration. Fixed income connects policy to pricing with yields, the slope of the curve, and credit spreads. Into year-end, the story is carry with control, cash yield stepping down, belly duration regaining appeal via roll-down and convexity, and spreads stable where quality is clear. We'll bias duration to 3 to 7 year, maintain an investment-grade core, and use long duration tactically as an equity hedge. The DEX curve panel highlights yields and monthly shifts. Yields decreased across most maturities in October, consistent with a nascent easing path. Portfolio math emphasizes the belly of 3 to 7 year to capture roll-down and convexity without letting term premium volatility at 20 to 30 year dominate P&L. As cash yields fall, redeploy into laddered investment grade to keep income durable. Use 10s/30s as hedges, not as income engines. On a trailing 12-month basis, high yield is positive 8.2%. While TLT is positive by 2%. October alone saw TLT positive 1.4% as yields fell. The interpretation is straightforward. Carry works, but your duration placement determines the ride. We build around an intermediate investment grade core for dependable income, a smaller, selective high-yield sleeve where fundamentals justify it, and a tactical long-duration allocation that pays when risk sells off. Avoid stretching for yield in credits that rely on the market's kindness to refinance. Let the belly do the base case work. Let the long end hedge the downside. This deck is built to be reused by bringing the charts into client reviews, prospect calls, and webinars. Lead with why the policy is easing, services are resilient, and the curve is starting to help again. That's why we keep a quality growth core, add belly duration, and hedge systematically. Emphasize that we're not betting on stimulus, we're navigating toward neutral with discipline. Point prospects to trial resources and, for firms on platform, note the ability to white label charts with your logo. Close each conversation with a 2-line playbook where we lean in, where we hedge, and why that mix is built to compound through different weather. Use this deck with clients. It's designed to help you communicate clearly and defend decisions. I'm Jason Pries, and this is the Pries Perspective. For full disclosures, visit priescapital.com/disclosure. Hopefully this was helpful, and I'll see you next month.